Now, live from KUSI, this is Good Business San Diego. Sponsored by Wilsey Asset Management.
Hi, I'm Roy Robertson. Welcome to Good Business San Diego, where we talk about the topics that are most important to you, your home, your health, your family, and your money. And the following portion is brought to you by Wilsey Asset Management. Your investment portfolio may have performed extremely well as the stock market has climbed to record highs, but is there risk in holding some stocks too long? Brent Wilsey, president of Wilsey Asset Management, is here with advice on how to manage an over-inflated portfolio.
Yes,
I like the analogy that you make to a balloon. And it's going to burst.
It's going to burst, and you see the balloon get bigger and bigger, and you know it's going to burst. And then it does, like, oh gosh, we shouldn't put so much air into it. Well, the same thing with the portfolio. You see the portfolio getting bigger and bigger, and you know emotionally, well, I know it's risky, but it's going up, and I can't sell because I like what's in there. And the big one, that is a big mistake, people hate paying taxes. And I hate paying taxes. I'm sure you do.
Oh, no, I enjoy it.
Yeah, oh, you're the rare exception.
I don't think so. Yeah, I know what you're saying.
But everybody hates paying tax, so they make that tax decision over the economic decision. Right. And you should never do that, because when you have you did what? You had an investment, $100,000, went to $200,000. Okay, well, I did well, but I don't pay the taxes. Well, tax is about 20%, give or take a little bit there. So you sell the $200,000 portfolio, you'll pay 20 grand. But if you lost 20% of that portfolio because of the market, you've lost twice as much. You've now lost $40,000. And when you sell that higher position, you can buy something that's less risky, that's at lower valuations, do much better. So don't be afraid to pay taxes, because long term, and I'm talking 5, 10 years, you'll do much better by paying those taxes than trying to avoid them. Not paying taxes.
So a lot of people they're exposing themselves to this market risk. I like what you said about this. You said you relieve the pressure on your portfolio before the market does it for you. So if you hold it too long, there's a market downturn, you're stuck and you're paying less in taxes if you just bite the bullet and decide to do it.
And you just kind of trim the oversized positions, the over-concentrated positions that you know are too expensive. And the first thing we talk about is over-concentration. You have investments done very well. It's up, we have in our portfolios investments up 500,000%. We keep trimming them back a little bit. And what we do is that when you have investments that become 10, maybe 12% of the portfolio, say, gee, if that would have dropped 20, 30%, like just last week, I think maybe it was this week, IBM in one day fell 25%. That would destroy your portfolio return. So you want to make sure you don't have over-concentrated positions. So instead of being 10 or 12%, you pull them back down to maybe 7 or 8%. Now, I know people are going to say, you're going to look at 6 months later, oh, I should have held on to it. That is going to happen. But if your objective is not to take a lot of risk, you have to make these decisions, and you may even pay tax. But you want that low-risk portfolio, these are things you have to do.
It's all about the risk management, as you always point out, right? So how do we know when it is time to sell? How do you begin to make that determination? Do we have enough time? Are we committing enough time to assessing the situation?
Well, the thing you look at, if you don't know why you bought something, you don't know when to sell it. If you just bought it because, oh, everybody's buying it, I'm going to buy it. When we invest in companies, and when you're doing this yourself, or your broker is, or your advisor, whoever, they should have a reason what they paid for that and what it is worth in the future. And if you don't do that, it's all based on the numbers, because emotionally, that's going to destroy your portfolio long term. If you just do it because you love the company, or because, oh, everybody's doing this, you're not going to do well long-term investing. But if you have a reason why you bought it, you'll have a reason when to sell it. And the same thing. You're going to sell this overpriced position. You're going to wait, find something else lower price, which reduces your risk. And again, you're going to pay tax on that. But if your concern is about, I don't want a risky portfolio, you have to make these decisions to sell out of these risky positions that you have in the portfolio, pay the tax, and reduce your risk. And again, I'm not talking about buying bonds or gold. I'm talking about keeping the risk on your portfolio down. And I tell people, the market's not risky if you do the right things. It's risky if you do silly things. Then you're going to take on more risk.
And the bottom line is always that you got to do your due diligence on this. I mean, you've got to really pay attention to what you're buying and when to sell it if you need to.
And you have to realize, if you're doing it yourself or if you're with a broker advisor, what are they doing to really look at the risk in your portfolio? And again, it's based on, and you're buying businesses, it's based on the numbers. Look at the numbers.
Don't let that balloon pop.
Don't let that balloon pop.
Find Brent online at smartinvesting2000.com. We'll be right back.